Aavas Financiers, once a market favorite, is now down more than 65% from its peak. Back in early 2022, the stock was trading near 3200 rupees. And today it is back to 219 levels. 6 years down the line, zero returns. So, what went wrong? And more importantly, is this a comeback story or a value trap? Let's first understand the business. Aavas Financiers is a housing finance company, but unlike big banks, it focuses on a very different customer base. First, low and middle income families. Second, mostly people living in semi urban and rural India. Third, specifically self employed people without any formal income proof. These are the people who are ignored by the big banks, but still they dream of owning a home. Now, Aavas Financier offers home loan, home construction and improvement loans, loans against property. And the key strategy, small ticket loans, which means higher interest income but also higher sensitivity to economic changes. Now, here's where the real story begins. To understand why the stock fell, you need to understand what changed after year 2021. During COVID, interest rates were at historic lows. Loans were cheap, EMIs were affordable, so people borrowed more, and housing demand boomed. This was the golden phase, and that's when our stock peaked in 2022. But then things flipped. Inflation started rising globally. To control this, RBI began increasing interest rates aggressively. And when interest rates goes up, your home loan become expensive, your EMI increases, and your affordability drops. And here's the key. Aavas customers are low income borrowers. Even a small increase in their EMI can delay or cancel their home buying decision. And what happens next is fewer people took loans, loan growth slows down, and housing finance companies get hit. But that's not all. Global uncertainty, inflation concerns, and geopolitical tensions can further impact the spending power of our core customers. But here's the twist in the story. Despite all the fall, the business model is still niche. Asset quality has remained stable, and India's long term housing demand is intact. So, fundamentally, the story isn't completely broken. Now, the big question is this just a cyclical slowdown due to interest rates, or has the growth story permanently slowed down? Because if interest rate ease and demand comes back, this could be a strong comeback story. But if not, this might remain a value trap for years to come. Now, let's look at the financials because this is where the story gets really interesting. On the surface, the business looks very strong. If we go down, you will see Aavas loan book has grown from 4 billion Indian rupees to more than 200 billion rupees. That's almost 50 times growth. Even the branches have increased from 35 to nearly 400 today. So clearly, the company has scaled massively. And it's not just the growth. If you look at the profit, you will see that the net profit has grown from 6 crores to over 600 crores today. That's a solid compounding story. So, if growth and profits are strong, why is the stock still down 65%? Because when you go deeper, the problem is not growth, the problem is slowing growth. In the last few years, although the loan growth is increasing, disbursements are also rising, but the pace of growth has been slowing down. And markets do not like slowing growth, especially for the companies that were once high growth companies. Now, let's talk about the risk because this is where investors get cautious. Now, if we look at the gross NPA, you can see that in December 2023, it was 1.09%. In December 24, it has slightly up to 1.14%, and now in the recent quarter, it was again up to 1.19%. It's still under control, but clearly trending upwards. And remember, Aavas lends to low income borrowers, which means even small economic stress can impact repayments. Now, let's talk about the returns. If we go up and see the return on equity, it is over 14%, which is decent, but not exceptional for a company that once traded at premium valuations. And now comes the most important part, valuation. Currently, the stock PE is 14, which is, if we see the historic average, If we go here to the PE ratio of last 5 years, it was around 28.5. And if we see the last 10 years of PE, it was over 40%. Similarly, if we see the price to book of last 10 years, it was 5. And if we look at the last 5 years median price to book, it is 3.9. Similarly, price to book is currently down to 1.9 compared to 3.9 if you compare it with the 5 year average. So clearly, the stock is much cheaper than before. But here's the catch: stocks do not fall without a reason. The market is basically saying its growth is slowing, risk is slightly increasing, and returns are not as high as before. But here's one positive signal. If we see, promoter holding has increased significantly. So it was in December 24 quarter, it was 26.47%. And now it is 48.95%, which is nearly 49%, which shows confidence from the promoters. So what is the final picture? The business still growing, profits are still compounding, and valuation has become attractive. But at the same time, growth is slowing, risk is inching up, and macro conditions are still uncertain. So now the big question is this a temporary slowdown or a long term structural change? Now, let's look at the chart, because sometimes price tells a story that numbers don't. Currently, Aavas Financiers is trading around 1100 levels. And here's the shocking part: this is the same level where it was back in 2019. So, for almost 6 years, the stock has gone nowhere. Now, let's go back to 2022. This is where the stock has made its peak of around 3200 levels. And from there, the stock has corrected more than 65%. Now, look at the green line. This is the 300-day moving average, which tells us the long-term trend of the stock. And currently, the stock is trading below its 300-day moving average, which indicates that the long-term trend is still weak. Another interesting story: the stock has been consistently making lower highs and lower lows, which is a classic sign of a downtrend. So if we see, it made a high here, then lower high, then again lower high, then again lower high, then again lower high, then again lower high, and then it goes up up up. Then again, if you see from here, 16th April, it was here, then it was here, then it was again lower, and then it was again lower. So yeah, but now the stock, if let me remove all these drawings, so the stock is approaching a very important zone. Historically, around 1100 to 1300 range, this level has acted as a strong support in the past. And once again, the stock is testing the same zone. So now the big question is, will this level hold again, or will the stock break down further? Because if this support holds, there could be a bounce or consolidation. But if it breaks, we could see further downside. Here, I want to add a quick disclaimer. This analysis is purely for educational purposes. I am not a SEBI-registered advisor, and this is not a buy or sell recommendation. Please do your own research or consult your financial advisor before investing. Okay, so that was a complete breakdown of Aavas Financiers. We have discussed the business model, we have gone through the financials, and we have also analyzed the technical chart. Now, it's up to you to decide whether this is an opportunity or something to stay away from. If you found the video helpful, make sure to like the video and subscribe to this channel. I keep bringing such deep dive analysis on stocks. I'll see you in the next one. Till then, take care and invest wisely. Thank you so much.